Whoa, wait a minute. Visa just posted a blowout earnings report, and the stock still fell? You heard that right. It's one of those market moments where good news is suddenly bad news, and investors are scrambling to make sense of it. Meanwhile, Booking Holdings crushed expectations but got punished. Mondelez beat but still dipped. And some under-the-radar stocks like Tetra Technologies and Rocky Brands, they're quietly making moves that Wall Street can't ignore. What's really going on here? Buckle up, because in the next 15 minutes, we're diving deep into what's moving after hours and what it could mean for your money. Visa reported a strong Q3, beating earnings estimates with a non-GAAP EPS of $2.98 versus $2.84 expected. Revenue came in at $10.2 billion, above the forecasted $9.84 billion. Cross-border transactions were up 12%, payment volume rose 8%, and processed transactions jumped 10%. But here's the curveball. Despite all that, the stock dropped around 4% after hours. Why? Some analysts believe the market already priced in the good news, and traders were looking for something extra. Others point to cautious guidance and broader concerns about slowing global growth. Next up, Booking Holdings, the online travel behemoth. Their second quarter numbers looked solid. Earnings and revenue topped Wall Street's estimates. So naturally, the stock soared in after hours. Right? Not quite. Shares actually slipped. Despite strong performance in Europe and the Americas, analysts flagged rising competition, flat guidance, and some signs of demand softening in Asia-Pacific markets. In short, investors seem nervous that the post-pandemic travel boom is finally starting to cool off. Let's talk snacks. Mondelez, the company behind brands like Oreo, Cadbury, and Trident, also beat expectations for Q2. EPS and revenue were both slightly above the consensus. Still, the stock dipped a little after hours. Why? Analysts think it's a valuation issue. The stock's been riding high on defensive growth appeal, and with inflation easing, investors might be rotating out of staples. Plus, input costs are stabilizing, meaning profit margins aren't expanding as fast as they were last year. Now here's a name you probably didn't expect. Tetra Technologies, TTI. This small-cap oilfield services company blew past expectations with Q2 adjusted earnings of 9 cents per share and revenue of $174 million. That may sound modest, but it beat estimates and sent the stock up 4.5% in after-hours trading. What's more, they raised full-year guidance and reported record EBITDA with 20.6% margins. The big takeaway? Tetra's strength in completion fluids and its moves into battery storage and desalination could give it some serious tailwinds in a tough sector. On the flip side, Ryerson Holding, RYI, had a rough quarter. This industrial metals supplier missed on both earnings and revenue, reporting $0.08 per share versus $0.16 expected. Revenue declined 4.6% year over year. Even with a slight rise in shipment volume and better EBITDA, the stock fell nearly 3% after hours. Management blamed soft OEM demand and a continued downturn in the manufacturing sector. For Q3, Ryerson is guiding lower on shipments and flat pricing. Definitely one to keep on your watch list, but maybe not your buy list right now. One of the biggest surprises came from Rocky Brands, RCKY, a footwear company that most investors probably haven't looked at since 2020. Q2 EPS came in at $0.55, more than double the $0.25 expected. Revenue jumped 7.5% to $105.6 million. Gross margins improved 230 basis points, and the company posted a 50% gain in adjusted operating income. Investors rewarded the stock with strong wholesale bookings for the back half of the year. This under-the-radar retail play might just have more room to run. BlueLinx, BXC, a major building products distributor, reported Q2 earnings that disappointed investors. EPS of 70 cents was far below the $1 consensus, even though revenue grew 2% to $780 million. Specialty product margins declined, and even though sales volumes rose slightly, profit margins were squeezed. The stock fell 3.1%. The company did repurchase $20 million in shares and launched a new $50 million buyback plan. But until housing activity rebounds more strongly, investors are cautious. So what's the common thread here? Solid earnings aren't enough right now. Valuations are high across the board, and investor sentiment is jittery. The market is acting more like a show-me environment, where you don't just need to beat expectations. You have to blow them out of the water. Stocks like Visa and Booking didn't do enough to justify their current premiums, while smaller players like Tetra and Rocky are finally getting some love for consistent execution and growth potential. So what should you do with all this? If you're a long-term investor, don't panic over after-hours volatility, but do pay attention to guidance and cash flow. And if you're looking for the next big opportunity, don't sleep on those lesser-known names with strong fundamentals and smart management. Want more real-time breakdowns like this? Hit that like button, subscribe to the channel, and turn on notifications so you don't miss the next trend. Drop a comment. What's your take on Visa's dip or Rocky Brand's rise? Until next time, stay sharp and stay invested. But before you go thinking Visa's facing a long-term slowdown, let's pump the brakes for a second. This isn't the first time we've seen a solid earnings beat followed by a knee-jerk sell-off. In many cases, it's institutional investors rebalancing or locking in profits. Plus, with interest rate cuts still on the radar for later this year, payment stocks like Visa could bounce back fast. Long-term, Visa continues to dominate its space, and analysts are still bullish on its cash flow strength, global brand, and digital payment infrastructure. So if you're thinking this dip is doom and gloom, it might just be the setup some investors were hoping for. Bottom line, whether you're a short-term trader looking for momentum plays or a long-term investor seeking steady compounders, Visa's worth keeping on your radar. The after-hours dip could be a buying opportunity if the fundamentals stay strong and macro conditions turn favorable. Now we want to hear from you. Are you buying the dip on Visa? Or are you steering clear until the next Fed meeting? Drop your thoughts in the comments. Hit that like button if you learned something new. And don't forget to subscribe so you never miss a market-moving story. Thanks for watching Asking for a Trend. We'll see you in the next one.